the Fed job should focus on delivering inflation to 2%. If you look at it, I look at the data yesterday, that the average core PC deflator last 20 years, 2.1, Fed is 2. So it's not 4. You cannot talk exactly 2%, And only country that, little bit high inflation in the UK, like 2.8 last 20 years. Japan still below 2%, Canada below 2%, Eurozone still below 2% for inflation last 20 years. So if you move inflation target from 2 to 3, like in typical Taylor rule, for every 100 basis point move in inflation, you require, minimum 150 basis point increase in interest rate to control that back. So I think it would be counterproductive,
Okay.
Let me ask you a little bit about what's been happening in bond markets. We got a stat yesterday that China had offloaded the most U.S. bonds and stocks in 4 years in August. We know, of course, China has been a massive holder, I believe the second biggest holder of U.S. debt. Do you think that trend is going to continue? Clearly, the Chinese authorities are keen to defend the yuan and prop it up. And do you think this dynamic is going to persist? And if so, what does that mean for the direction of travel for bond yields in the U.S.?
Some experts are digging the data from the TIC. They say the Chinese holding of dollar hasn't changed much. So there's a decrease in treasury, but there's an increase in holding of agency mortgage and cash. So essentially, over the last 10 to 15 years, the accumulated foreign assets has been diverted into, the Silk Road Fund, BRI. So the Chinese total foreign assets going up, but the reserves at 3 trillion, because actually it was too much. I was, quite involved, say, you just too much reserve earning too low interest rate. Yeah. Why don't you, use that for sovereign wealth fund, making money like 5 to 10% rather than be happy with 2%. I think they're actually doing a good job on that.
I think one of the differences that also what we're seeing in treasury markets, even though you could say the UK have a similar fiscal issue, similar to the US, and there are concerns there, and that's being priced in terms of premium. The difference between UK and Europe versus the US is that the growth backdrop here is a lot worse than it is in the US. And because of that, does it make you more incentivized to want to own European bonds or gilts versus owning US treasuries?
I think, for now, the UK government was taught a lesson last year. So essentially, in the report we just released at UBS Asset Management, we called the, so fourth awakening. So they essentially were saying that the bond vigilante is coming back. So this is very important for assets pricing, equity, house price, fiscal policy, monetary policy. So no longer there's a free ride on bond market anymore. So the government has to be very careful in terms of future. That you saw that last September. You saw that in Treasury. So a few months ago, most people expect the U.S. government deficit would keep going down with growth strong. It was 3.9% last year, and just going up with growth strong. That is quite alarming for bond investors.